After spending my entire career studying how money works, how markets behave, and how people build wealth over time, I'm going to tell you something that just might surprise you. For decades, the world of finance has been selling ordinary investors a story that sounds really good, but doesn't hold up when you look at the actual results. Wall Street brokers, financial advisors, they all offer guidance, investment plans, strategies that appear trustworthy and professional. You walk into these offices with marble lobbies and expensive furniture. Everyone's wearing tailored suits. They hand you these glossy brochures with impressive-looking charts and graphs. It all looks so legitimate, so sophisticated. But behind all that polish, there's a fundamental lie that's persisted for generations. And this lie quietly siphons wealth from everyday investors and funnels it straight into the pockets of the financial industry itself. Now, I've been a critic of certain practices in the financial industry for a long time. Practices that favor fees over performance, complexity over clarity, short-term speculation over long-term value creation. And in my recent interviews and shareholder letters, I've been emphasizing a simple principle that people need to understand. Most financial advisors do not prioritize your wealth. They prioritize their own compensation. That's just the truth. It's a hard truth that many investors find difficult to confront. But confronting it has profound consequences for your retirement savings, for your ability to accumulate wealth, for how well you can withstand market volatility. Let me explain what the lie actually is because it's subtle. It's not obvious fraud or theft that would be easier to spot and avoid. No, this lie is more insidious because it sounds so reasonable, so professional. The lie is this, that financial advisors, by crafting complex portfolios, by implementing sophisticated market timing strategies, by selling you exotic investment products with names you can barely pronounce, that they can consistently outperform the market and deliver superior returns for you as their client. It's a compelling promise, right? Give me your money, and because of my expertise, my training, my access to research and analysis, I'll beat the market for you. I'll make you more money than you'd make on your own. But here's the reality, and this comes from decades of data, not just my opinion. The vast majority of actively managed funds fail to outperform low-cost index funds over long periods. This isn't even controversial in academic circles. It's established fact. There's research by S&P Dow Jones Indices that track this over a 15-year horizon. You know what they found? More than 80% of actively managed equity funds underperformed the broader market. 80%. Think about that for a second. If you go to a financial advisor and they put you in actively managed funds, which is what most of them do because that's where they make their money, you have better than an 80% chance of doing worse than if you just bought a simple low-cost index fund and left it alone. In other words, these products that are being sold to you as specialized expertise, as professional management, as sophisticated strategy, statistically, they're more likely to underdeliver than to outperform. You're paying extra for worse results. It's like paying a premium price for a car that's slower and less reliable than the basic model. Now, why does this happen? It's not necessarily because financial advisors are bad people or incompetent at their jobs. Many of them are smart, hard-working individuals. The problem is structural. It's baked into how the industry works. First, there are fees. Every time someone touches your money, there's a fee. Management fees, transaction fees, administrative fees, 12b-1 fees, they pile up, and these fees compound over time. Just like returns compound, except they compound against you. If you're paying 1 or 2% in fees every year and the market returns 7 or 8%, you're giving away a huge chunk of your returns over 30 or 40 years. Those fees can cost you hundreds of thousands of dollars. Second, there's the issue of trading. Active managers buy and sell constantly trying to time the market or find the next hot stock. Every trade has costs. Transaction fees, bid-ask spreads, market impact, and every trade creates a taxable event if you're in a taxable account. All of that eats into returns. Third, and this is important, beating the market is really, really hard. Not because the people trying to do it aren't smart. Many of them are brilliant, but because markets are reasonably efficient. When there's an opportunity to make excess returns, professional investors with billions of dollars and armies of analysts jump on it immediately. By the time you or your advisor hears about it, that opportunity is usually already gone. And fourth, and this gets to the heart of the lie, your advisor's interests. and your interests are not perfectly aligned. Your advisor gets paid based on assets under management or commissions on products they sell you. They make money whether you make money or not. In fact, they often make more money by selling you complex, high-fee products than by putting you in simple, low-cost index funds. Even if they genuinely want to help you, the incentive structure pushes them toward recommendations that benefit them more than they benefit you. This is what I mean when I say the lie is subtle but powerful. Nobody's telling you outright, "I'm going to charge you a bunch of fees and probably deliver worse results than a passive index fund." Instead, they're telling you about their proprietary research, their sophisticated models, their track record, all designed to make you feel like you're getting something special, something worth paying for. But the data doesn't lie, over and over across decades. The evidence shows that most people would be better off putting their money in a low-cost index fund and leaving it there. Warren Buffett himself, and I know a thing or two about investing, has recommended exactly that for ordinary investors. I've said publicly that when I die, the money I'm leaving to my wife should be invested in a low-cost S&P 500 index fund, not in hedge funds, not in actively managed mutual funds, not in some complex strategy, just a simple index fund. Why? Because it works, because it's low cost, because it doesn't require you to pick the right advisor or the right fund manager or time the market correctly. You just own a piece of American business. And over time, American business has been remarkably profitable. The financial industry doesn't want you to know this because if everyone just bought index funds, a whole lot of people in the industry would be out of jobs. The entire apparatus of stock picking, market timing, complex portfolio construction, it would become largely unnecessary, and that would cost Wall Street billions in fees. So they keep selling the lie, keep making it sound complicated, keep suggesting that you need their expertise, and millions of investors keep paying for underperformance year after year without realizing there's a better, simpler way. Let me give you an analogy that I think really captures what's happening here, and it's one I've used before because it's so accurate. Wall Street operates like a casino in which the house always wins. Now, they're not cheating. That's important to understand. They don't have to cheat. They've structured the game so that fees, commissions, and hidden expenses tilt the odds decisively in their favor. You might win sometime, sure, but over the long run, the house, meaning the financial industry, always comes out ahead. Here's a concrete example. A mutual fund that charges 1.5% annually may seem reasonable when your advisor presents it to you. It's only 1.5%. They'll say that's a small price to pay for professional management. But let me show you what that actually means when you compound it over decades. If the market returns 8% annually and you're paying 1.5% in fees, you're actually only getting 6.4%. That might not sound like a huge difference, but compounded over 30 or 40 years, that fee can erode 25 to 30% of your potential returns. 25 to 30%. That's money that should be in your retirement account, money that could have compounded and grown, but instead it went to pay fees. You worked for that money, you saved that money, you took the risk of investing it in the market, and then you gave away a quarter to a third of the returns to someone else. And here's the real kicker. Financial advisors are often incentivized to recommend products that maximize fees rather than return. They're not sitting there thinking, how can I get the best outcome for my client? They're thinking, which products pay me the best commission? Which funds have the highest management fees that I get a cut of? It's a conflict of interest that rarely aligns with your long-term goals as an investor. Now, I'm not saying all financial advisors are bad people who deliberately harm their clients. Many of them genuinely believe they're providing value, but the system they operate in creates incentives that push them toward recommendations that benefit them more than they benefit you. And that's a structural problem that's really hard to overcome. This problem has gotten magnified by the rise of complex financial instruments over the last couple of decades. You've probably heard about some of these structured notes, leveraged ETFs, alternative investments, private equity funds. They're marketed to investors as opportunities to beat the market or access unique growth potential that regular investments don't offer. The pitch is always the same. This is sophisticated. This is what the wealthy do. This gives you access to strategies that weren't available to retail investors before. But I caution people strongly about these products. They're often opaque, meaning you can't really see what's inside them or understand how they work. They carry high fees, sometimes multiple layers of fees that aren't immediately obvious, and they consistently fail to produce the promised outperformance. The marketing materials show impressive-looking projections and historical performance that's been cherry-picked. But when you look at actual results across thousands of investors over long periods, these products don't deliver. Even seasoned professionals struggle to evaluate the true risk and reward of these complex instruments. I mean, really struggle. If someone who's been in the industry for 30 years and has all the analytical tools can't fully understand what they're buying, what chance does an ordinary investor have? It's nearly impossible for regular folks to assess whether the investment is appropriate for their objectives, whether the risks are worth taking, whether the fees are justified. And you know what happens? People buy these things because they sound sophisticated, because their advisor recommends them, because they want to believe there's some secret strategy that will make them rich. And then years later they discover they would have been better off with a simple index fund. The consequences of this misalignment between advisor interests and investor interests are just enormous. We can see it playing out right now in America. We're facing a retirement crisis. Social Security provides limited security. It was never designed to be people's only retirement income, but for many Americans, it's all they've got. And personal savings are insufficient to bridge the gap between what Social Security provides and what people actually need to live on in retirement, according to the Federal Reserve. And these numbers are shocking. Nearly 40% of U.S. households have less than $25,000, 0 cents in retirement savings. 40%. We're talking about tens of millions of people who are approaching retirement age with almost nothing saved. And of those who do save, many of them are investing through advisors who recommend high-cost funds or market timing strategies that fail to deliver the returns they need. Think about what that means on a human level. That's people who worked their entire lives, who tried to do the right thing, who trusted professionals to help them prepare for retirement, and who end up in their 60s and 70s without enough money to live with dignity and security. That's not just a financial failure, that's a tragedy, meaning my warning here is not merely philosophical. I'm not just complaining about Wall Street because I don't like them or because I have some ideological problem with the financial industry. This is a practical call to action. Real people's lives are at stake. What I advocate for, and I've been consistent about this for decades, is simple, low-cost, diversified index funds that track broad market performance. That's it. Nothing fancy, nothing complex, nothing that requires a PhD in finance to understand. Why index funds? Because they work. The strategy has been proven to generate wealth over decades without the drain of excessive fees. When you buy an index fund, you're buying a tiny piece of hundreds or thousands of companies. You're diversified automatically. You're not making a bet on any individual stock or sector. You're just saying, I believe that American business over the long run will be profitable and will grow. And history shows that's been a very good bet. The fees on index funds are tiny, often 0.03 to 0.1% annually compared to 1 or 2% for actively managed funds. That difference compounds enormously over time. Over 40 years, the difference between a 0.05% fee and a 1.5% fee on a $100,000. And that's real money. That's the difference between a comfortable retirement and struggling to get by. And you don't need to time the market. You don't need to pick the right stocks. You don't need to constantly monitor your portfolio or make adjustments. You just invest regularly year after year through market ups and downs and let compound returns do their work. This is the strategy I recommend for my own family. This is what I've put in my will for my wife. 90% in a low-cost S&P 500 index fund, 10% in short-term government bonds. Not because I don't understand sophisticated investment strategies. I understand them very well. But because I know that this simple approach over time beats almost everything else after fees and taxes. The financial industry doesn't want you to know how simple wealth building can be. Complexity is their friend because it justifies their fees. But simplicity is your friend because it works. It's cheap, and it doesn't require you to trust someone whose interests may not align with yours. That's the truth Wall Street doesn't want you to hear. And that's why I keep repeating it year after year in every forum I can. But there's another layer to this problem that I need to talk about, and it's actually even more damaging than the fees themselves. It's the behavioral pitfalls that get exploited, sometimes intentionally, sometimes not, by the financial industry. The investors are human beings. We're not rational, calculating machines. We're swayed by fear, by greed, by the allure of short-term performance. And these emotional responses lead people to make terrible decisions, specifically buying high and selling low, which is exactly the opposite of what you should do. This pattern destroys long-term returns more effectively than almost anything else. Let me explain how this typically plays out. The market goes up for a few years, everything's looking good, your neighbor tells you he made 30% in some tech fund last year, you start feeling like you're missing out. So you look at your boring portfolio and think, I need to get in on this action. You sell your solid, diversified holdings and buy whatever's been performing well recently that's buying high. Then the market corrects, as it inevitably does. Suddenly, that hot tech fund is down 40%. You panic. You can't sleep at night. You think I need to get out before it gets worse. So you sell. That's selling low, and the cycle repeats. Now, advisors, whether intentionally or not, often exploit these behavioral tendencies. How do they do this? By emphasizing market timing, by constantly talking about performance benchmarks, by making speculative recommendations that sound exciting and sophisticated. They're feeding into your fear of missing out, your desire for quick gains, your belief that there's some secret to beating the market. The result is this vicious cycle where investors consistently underperform the market, not because the market didn't do well, but because their behavior prevented them from capturing those market returns. And meanwhile, the financial industry is collecting substantial fees along the way. They get paid whether you make money or lose money, whether you buy or sell, whether you're in the market or out of it. My advice on this is strikingly straightforward, and I've been saying the same thing for 50 years. Stay disciplined. Avoid speculation and focus on investments that you can understand and hold for decades. Not weeks, not months, not even just years, decades. That's the time horizon you need to think about. Now let me show you some numbers that really illustrate the impact of what I'm talking about. Consider the historical record from 1985 through 2025. That's 40 years of data, a nice long period that includes multiple bull markets, multiple recessions, crashes, recoveries, everything. The S&P 500 has delivered an average annual return of roughly 10% before fees. 10% a year compounded over decades is how ordinary people become millionaires. It's not glamorous, it's not exciting, but it works. Now, a high-cost active fund may advertise similar returns in their marketing materials. They'll show you charts that look impressive. But here's what they're not emphasizing. After deducting 1.5 to 2% in management fees annually, plus all the other associated costs, the investor's net gain falls to around 8% or less. Warren, you might say that's only a 2% difference. What's the big deal? Well, let me show you what that 2% difference means when it's compounded over 30 years. A $100,000 0-cent investment growing at 10% per year would become roughly $1,700,000 after 30 years. That's life-changing money. That's a comfortable retirement. That's financial security for you and your family. At 8%, that same $100,000 grows to just over $1 million. 0 point still significant, but you're talking about a difference of $700,000. $700,000. That's not a rounding error. That's real wealth that could have been yours, but instead went to pay fees. Those fees that are framed as management costs or premium services, they're quietly siphoning away nearly half the wealth that could have been accumulated. Half. And most investors don't even realize it's happening because it occurs gradually a little bit each year, invisible in the day-to-day fluctuations of the market. And here's something that really drives this point home. My own investment practices. I'm not just preaching theory here. Berkshire Hathaway, the company I've run for over 60 years, famously avoids paying financial intermediaries to manage its capital. We don't use mutual fund managers. We don't use financial advisors. We don't pay Wall Street to tell us what to do with our money. Instead, we invest directly in businesses that we understand and believe will grow over time. And when we do invest in the stock market broadly, we use index funds that provide long-term sustainable growth without unnecessary fees.